Coming up on Market to Market, the leader of the free world drops out of the Paris Climate Accord. The unintended effects of winemakers adding cannabis to their product lines. And replanting or re-replanting, decisions to make as rainy weather returns. Those stories and market analysis with Darin Newsom next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, June 2 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Employers put a few more people back to work last month, even as the employee pool got smaller. Trying to find a job wasn't the problem, but finding one with good pay stood in the way of growth. Labor Department data shows 138,000 jobs were created in May, enough to push the unemployment rate to the 16-year low of 4.3%. However, the fall is based on a drop in the number of people looking for work. Weakness in job creation pulled Creighton University's Business Conditions Index almost 6 points lower, but managed to stay above growth neutral for the 6th month in a row. And Wall Street closed out the week with the Dow, S&P, and NASDAQ all posting record highs. Whether jobs are created in mining or manufacturing, what is done with the final product can affect weather on the planet. Global climate change caused by greenhouse gas emissions is an accepted fact among 97% of scientists studying the issue. Estimates by some groups place 18% of the load on agriculture's back. Throughout his campaign, President Trump called the theory a hoax created by the Chinese, a tax, and costly nonsense. This week, the president made good on a campaign promise to drop out of an accord he believes places the U.S. at a disadvantage. The stock market rose, but not world opinion. Peter Tubbs has the details.
The Trump administration made the United States an outlier among industrialized nations by withdrawing from the Paris Climate Agreement the Obama administration signed in 2016.
I am fighting every day for the great people of this country. Therefore, in order to fulfill my solemn duty to protect America and its citizens, the United States will withdraw from the Paris Climate Accord.
Nearly 200 nations have mutually agreed to reduce their greenhouse gas emissions under the treaty in an effort to slow global climate change. The terms of the pact are voluntary and have no enforcement mechanisms, despite the United States holding the number 2 spot. Trump followed through with his campaign promise of withdrawing from the landmark agreement. The president also assured voters the move would provide economic benefits. Economists are skeptical.
Jobs, no, there'll be no positive impact on jobs. There could even be some loss of jobs because to the extent that, for example, Trump scraps the Clean Power Plan, then that's going to kill investment in environmental remediation and in scrubbers and things of that sort, which was quite an active field.
Environmental groups also voiced concern over the long-term ramifications of leaving the pact.
Well, this would be a historic mistake. This is an agreement that was hammered out over years of negotiation. It's a strong agreement. The only countries not in it right now are Nicaragua and Syria. For the U.S. to leave and the president to be the only president in the world who doesn't believe in climate change, the only climate denier, that would be a tragic mistake.
China, the world's largest emitter of greenhouse gases, remains in the group of industrialized nations and has made moves to play its part. Poor air quality has become a hot political issue in China as a growing middle class is demanding a reduction in the burning of coal to make their cities more livable. China recently canceled plans for over 100 new coal-fired power plants, throwing the nation's energy effort towards solar and wind. Questions remain on how long it will take to remove the United States from the agreement. The terms of the document require 3 years of participation by signees before withdrawal.
But begin negotiations to re-enter.
As an executive agreement, the president is able to join or withdraw without consulting Congress. For Market to Market, I'm Peter Tubbs.
29 states have legalized marijuana in one form or another. In the Pacific Northwest, home to a growing number of winemakers, the drug is legal for recreational use. Some vintners in the region are looking to create a value-added experience by offering both products. The combination has created a few unanticipated results. Colleen Bradford-Krantz has the story.
The Steeles moved to this sleepy corner of Oregon to produce premium, eco-friendly wines. But now, a decade later, the owners of Cowhorn Vineyard are also talking about a different crop, cannabis.
Well, we have Slowfo, Obama, Ox GDP. Last year we did about 30 plants. We had 5 different varietals or clones. This year we're going to go to closer to 60 plants.
While the Steeles are only branching out into medical marijuana, the state's recent legalization of recreational pot has sparked interest from more than a few winemakers.
We got to keep the gate closed because...
Catherine Bryan runs Deer Creek Vineyards with her husband. She says this corner of Oregon in particular is perfect for growing the two crops.
I think that the reason that we can do really well in the cannabis industry is because of the experience we've had growing grapes and being in the wine business, because I think that there's a lot of parallels.
However, pot farms and wineries don't always pair well. The explosion of recreational marijuana has come with a flood of disputes. Some vineyards and other farmers are accusing pot growers of stealing precious water rights. And some wineries are worried that the smell from outdoor pot fields could taint grapes. Marijuana is still illegal at the federal level, and winemakers must be careful to keep the business separate or risk losing the federal permit they need to bottle and sell their wine. Catherine Bryan's pot will grow on land next to her winery, be labeled with a different name, and financed as a separate company.
We're doing everything we can to be as transparent as possible and be a good example for the rest of the industry.
Like Bryan, the Steeles see tremendous potential as millennials drink more wine, but want their weed too.
They're looking for an experience of wine and weed. That's what it's called, wine and weed parties.
It remains to be seen whether this entrepreneurial cross-pollination catches on elsewhere. For Market to Market, I'm Colleen Bradford-Krantz.
The nation's farmers continue to fight Mother Nature. Some have managed to dodge the raindrops and finish planting. However, more than adequate moisture has become a problem for more than a few, as spring labors are now more likely to be found downstream. And despite their best hopes and wishes, the storm season rolls on in the south and southeastern portions of the country. Paul Yeager reports.
Memorial Day weekend ended with a bang in eastern North Carolina as a tornado ripped through a mobile home park in Sampson County. The area near Fayetteville was struck as utility poles and trees were shredded during the storm's peak. At least a dozen people were injured in the weather event that ripped through a similar location the previous week. In the Grain Belt, rain has let up in the Dakotas, most of Minnesota, Iowa, and Illinois. More rain fell again across Kansas, east to Ohio, and onto Pennsylvania. Only a small patch of the corn-producing regions of North and South Dakota are experiencing drought. The corn planting progress report from USDA reveals much of the eastern Corn Belt is behind schedule. The other states in red indicate below average pace. Overall, the 5-year stride remains as planting is 93% complete. The biggest stragglers are in Kansas and the Big Ten country of Wisconsin, Illinois, and Ohio, with more than 500,000 acres unplanted. And in the Hoosier State, more than 1 million corn acres are still in the bag, according to USDA. Many of the same states behind on corn are in the same boat when it comes to soybeans. The 18 states that plant 95% of the country's crop are 4 percentage points behind the 5-year average. For corn's condition, the amount of acreage considered good to excellent as compared to last year trails by 6 percentage points. More of the crop is in the poor to fair category with a 34 to 27 contrast year over year. Anecdotal evidence of replanting was reported this week on Twitter, but preventative planting acres aren't usually accounted for until August. Several seed companies told DTN last week that they were getting calls at historic levels for more bags, which, except for a few businesses, were still not at 1993 levels. As winter wheat matures, cooler and wetter conditions are delaying development of a bin-busting crop. According to USDA, only 50% of the crop is in the good to excellent category compared to last year's 63%. For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
South American exports and predictions of drier conditions across the U.S. only work to push the commodity markets lower. For the holiday-shortened week, July wheat fell 9 cents and the nearby corn contract dropped 2 cents. Oversold conditions, a larger than expected crush, and good weather pushed the soybean complex slightly lower as the July contract gave back a nickel. July meal bucked the trend, adding a dime. In the softs, July cotton shrank 40 cents per hundredweight. Over in the dairy parlor, June Class 3 milk futures squeezed out a penny. In the livestock sector, the August cattle contract rose $7.10 and nearby feeders surged $11.78. The July lean hog contract added to a multi-week run, moving up 8 cents. In the currency markets, the U.S. dollar index decreased 69 points. Crude oil stayed below the psychological $50 level, losing $2.14 per barrel. COMEX gold poured on $8.80 per ounce, and the Goldman Sachs Commodity Index retreated more than 9 basis points to finish the week at 375.45. Here now to lend us his insight on these and other trends is one of our regular market analysts, Darin Newsom. Darin, welcome back.
Thank you, Mike.
We're glad to have you. And in case you want to go over things again, you can listen to our Market Analysis and Market Plus podcasts anytime online at iptv.org/MTOM. Now, Darin, I want to kick us off here by talking about the U.S. dollar, the dollar index. We were screaming all of last fall when the dollar was up around 100. We're now down this week, closed mid-96. We've pulled back 4 points.
Yep.
When are we going to see that transfer to a little bit more strength in the grain markets and particularly in the wheat market? Is it going to be wind at our back at any time soon?
No.
Okay.
And why would it be? You know, I know the old adage is, you know, if the dollar's coming down, and the dollar's still got some room, you know, if you know, I just got through doing all my monthly charts on DTN. The dollar still has some room to come down. So we're not at the bottom of that downtrend yet. But as you said, grains aren't reacting to this. Crude oil's not reacting to this. The only one that's shown a little spark of life is gold. Fundamentally, there's no reason for the grain markets, for crude oil, and for so many other commodities to rally at this point. I mean, the dollar acts as a benefit to commodities when you see great increases in demand. Right now, we've got decent demand projected across the board, so we're not seeing anything above and beyond what's not already been talked about, what's not already been calculated and subtracted in off total supplies. So the grains have no reason to rally in here. I mean, we've already been told how big the crops are going to be this year, next year, and what the ending stocks are going to be 15 months down the road. Why should any investment trader get overly excited about the situation because the dollar's coming down?
Given all of those, I mean, pretty bearish fundamentals, and let's focus in on the wheat market here. We know we've got a huge crop. We have a huge carryover from last year. We had phenomenal yields across much of Kansas. Harvest is underway. I haven't heard a whole lot of complaints so far in the Deep South. If there's no incentive for these investment fund traders to get excited, why aren't they dropping this wheat market even further? We bounced off that 420 mark in the Chicago and kind of climbed back to the upside. What's it going to take to move us one way or the other?
Well, right now we still have, we have as good as expected, as projected demand going on right now. Basis in the hard red winter market has been firming. I mean, it's kind of a funny thing to say that we've firmed. We've firmed from $1 under to like 85, 86 under. So I mean, okay, it's still a wreck. But you know, we've got demand going. We've reached a stalemate in the wheat market. Okay. Did any of the numerous events that happened since last February when the market, when the crop came out of dormancy early, has any of that affected the potential yield? We don't know. We'll see. We'll see when the combines actually run through the fields. For now, there's no reason for investment traders. We talked about earlier. There's no reason for investment traders to come in. There's no reason for them to sell it because we still have good demand and we have weak basis. The cash market, as far as the hard red goes, kind of a disaster. So it's cheap worldwide. Again, you can see good demand. Spring wheat, on the other hand, facing a little bit of problems, some dryness up in the Dakotas, up in the northern plains, seeing a jump in the spring wheat market. So the possibility is there. The possibility for winter wheat to move like that is there. It's just got to have a catalyst. And right now, until we know if there was any damage done, it's just not there.
All right. This range-bound trade is one of those things that a lot of folks are getting kind of tired of, I would imagine, particularly producers. And as we move to talk about the corn market, we got a question here from Alan in South Central Nebraska. Alan's on Twitter, and we encourage all of you to send us questions on Twitter, Facebook, Instagram, whatever. Just search for Market to Market, and we'll ask your question of our analysts. Alan wants to know, he says the corn market has been in a tight range for several months. Which way do you think it will break out? And how explosive will it be either way?
You know, logic would, looking at the markets, one would almost have to think, looking at the long-term monthly charts, that the breakouts could be to the upside. Again, why is this going to happen? Okay, number one, demand's going to have to stay stronger than what's expected. And so far, that's what we've seen. Dollar is coming down. We've got good shipments going on. We've still got good sales on the books. Talk out there this week was of this huge crop down in Brazil. You know, is it ever going to displace the U.S. supplies on the export market? It hasn't yet, and we're already into we've got another quarter left, June, July, and August. So, I mean, we've done relatively well. We usually get some sort of weather scare. The last 2 years, you know, as Naomi talked about when we had our panel discussion here at the end of March, we get this bump in the market up into the $4 range, $4.30, $4.50, but it's very short-lived. So just looking at history, it would seem that things are favoring the corn market bouncing up. Again, what's going to be the driver? The non-commercial trade is still holding a large net short position. They increased it as of the most recent CFTC report. So a round of short coverings sparked by, who knows, maybe a weather scare, maybe export demand staying a little stronger than expected. That could be what kicks us up here over the summer.
Given the fact that we have such a huge short position held by these speculative funds, would that make you think that the move to the upside would be fairly explosive?
It could be explosive. I mean, volatility could go up. I don't think we're going to go all that far because, again...
What are you watching then? I mean, on your charts, what do you see as a potential? You know,
450's held the last 2 years in the nearby contract, not necessarily the December contract, but in the nearby contract. So, you know, if we're looking at the July contract here for this month, and even, you know, then you get into the oddball September contract once the July goes into delivery. You know, you've got a shot at getting up into the, you know, 420, 440 range, maybe trying to hit that 450 once again, like we've done the last 2 years. On the board. You know, basis is still running weaker than normal. If we look at, you know, we're running about 40 cents under the SEP contract right now. So, you know, that could pull cash up to around 4, maybe a little above 4 on the national average. But it's just not going to last very long because, you know, let's look at what we saw in the March quarterly stocks report. Let's look at what we're expected to see in the June 30th quarterly stocks report, and that's plenty of corn still on hand. So we get the rally. If it happens by the end of this month, you know, we've got that report coming out to squash it again.
Okay. Let's talk about the soybean market. That has not been an attractive market to keep an eye on over the past 3 months. It seems, from the producer's perspective, we just keep giving ground in beans. Are we going to test that $9 mark on the nearby soon, in the next week or two?
Well, it's your, you know, path of least resistance in soybeans still seems to be down. You know, You know, we talked about the dollar earlier. Probably the biggest thing the U.S. beans have going for right now is the fact that the dollar is weakening. We're still seeing some pretty good sales each and every week. What we really have to watch in these weekly export sales and shipments is as we continue to build our unshipped bushels. We're running well above where we were last year as far as those go. Yeah, shipments are running okay, but it's this buildup of unshipped bushels.
And so the unshipped bushels, these are bushels that importers in China or wherever have said we want to buy
for this marketing year,
have not yet taken delivery.
Correct.
Okay.
You know, they were sold for the 16-17 marketing year. We're starting to get a little bit of a buildup of these again going into the last quarter. The threat is that, you know, if something happens and all of a sudden China decides to cancel these orders, and I know that's a very sore subject with farmers, with many folks in agriculture, but let's say we start to see these cancellations occur, you know, that's going to be a big problem for the market because all of a sudden those beans come back onto the market that had already been, you know, wiped off. You know, so right now our sales are actually something like 7% above what USDA is projecting for all of the marketing year. And that bothers me a little bit in the fact that what's going to happen to those if shipments do start to slow down.
Okay. We've got to talk about something exciting.
Okay.
Darin, let's talk about the cattle market.
Sure.
Live cattle screamed higher this week. $7 to the upside in the nearby. We saw cash take off like a rocket. What are your thoughts when you look at a market, particularly one that's as thinly traded as cattle are, and you see this kind of volatility in a week's time?
Yeah, I think, to me, this isn't a market that makes a lot of sense. You can talk to old-time cattle guys. Cash market's strong, and that's probably the core of this. You know, if you want to compare it to what's going on in grains, what's going on in crude oil, the cash market is really quite strong. Got good demand still for beef and pork and so on. But, you know, to me it comes down to, if I were just to take the name of the market off of its long-term monthly chart and just look at it for live cattle, feeder cattle, and hogs, it would tell me that the market's actually doing what it's supposed to be doing. So it's very possible that for no logical reason whatsoever, computers see the same thing. Now, I'm not saying that they really follow the technical patterns, and I know they don't, but it seems to be following, you know, what we've seen established over the last 6 to 9 months, where, you know, live cattle established a long-term uptrend, feeder cattle established a long-term uptrend, even hogs. Even with the huge sell-off that we saw leading up to this recovery rally, you know, everything looked good on monthly charts. So, you know, there's not a lot of fundamental reason for it except for strong cash markets, strong demand. But from a technical point of view, it just seems to be going the direction that it said it was going to, going way back on these charts. Okay,
well now let's take the fundamentals out of the picture. Let's just look at it from a technical perspective. Where do your charts show us next having a period of resistance in live cattle?
You know,
Can we go above 140 on the board?
You know, that's going to be the high that we saw, what was it, 4 to 6 months ago. And then we fell off. And of course, then in the cattle, you have the different contract months that create kind of a headache. You know, here the June had such a huge discount to what was it, the May or whatever it was. So you've got that problem, and that kind of skews the monthly charts a little bit. But to me, the initial target would then be back where we saw, say, the May contract run into some resistance. If we can pop through that, then what we're in then is the next leg of its, you know, usually uptrends last 5 waves. I think we're in something like, we're getting ready to go into our 5th wave now, if I recall correctly. You know, we've gone up a couple, we've pulled back a couple, so now we're setting up for the last wave up, which would certainly, you know, indicate that it should go through that previous high. And, you know, why fundamentally is it going to do it? I have no idea, because, you know, we seem to have plenty of supplies.
Sure.
Demand's very strong. If we ever get to the point where the cash market realizes that we've got plenty of supplies, you know, it could bring an end to this thing.
Now, feeder cattle, we saw $11 move this week in the front month. Are we up at a contract high?
If not, yeah, I'd have to go back and look at my weekly charts.
August contract closed at 158.75.
Yeah, we have to be right in the neighborhood, if not at a new contract high.
So does that tell you that feeders would be then entering their 5th phase or 5th wave yet again?
Yeah, I mean, if you go back to the monthly chart, it's a very similar pattern. And if we just go to the August contract itself and look at its weekly chart, you know, anytime you move to a new 4-week high, that's pretty bullish. Anytime you go to a new contract high, you know, it's bullish, but you really have to start being careful, because at any point, particularly when you get to a thinly traded market like feeder cattle, this thing could come tumbling down.
Okay.
So, because I like to call it a vacuum trade, it just doesn't leave anything underneath it. And so when it runs out of momentum, it tends to fall back. So, if we've got a good cash market, great. And if it can continue to build some support underneath this market, great. But for now, you just have to treat feeder cattle very carefully because maybe they're not quite, maybe we don't have the fundamentals to really push it to, continue pushing it to new highs, but it's looking good at this point.
Lean hogs. Darin, you talked about even lean hogs have moved into the uptrend, and they certainly have. We're on our 8th or 9th week now of movements up in the lean hog market. What's the top end of this thing look like?
Again, we've blown out the highs. Initially, it looked like, okay, we had a sharp sell-off, and so we were going to recover some of that. Well, we've recovered all of that and gone higher. Again, it comes down to we've got strong demand. The fundamentals still seem pretty solid in the hog market. Good kill every week. Bids still coming in strong, helping to support the market. And we've just got to run away at this situation. Now, we've seen these types of markets in the past, and they eventually do run out of gas. But right now, the hog could top out any week.
Okay.
But as long as we have that cash support, similar to cattle, this thing's going to try to keep climbing higher. Because it has no reason right now to back off until it just runs out of buy orders.
All right. Well, Darin Newsom, thank you so much for taking the time to be with us this week.
All right. Thank you, Mike.
That wraps up the broadcast portion of Market to Market. However, Darin and I will keep the conversation going, including answering more of your questions during Market Plus, which is available in podcast and video form on our website. While you're there, follow the links to our Twitter feed. Tweet us your questions via @MarketToMarket, and we'll get you the answers either during market analysis on the show or on our Plus segments online. And join us again next week when we explore how catfish farmers are fighting off foreign competition. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.